Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have our commodities guru back on the show, Rick Rule. Rick, thank you for coming back on the show.
Steve, always a pleasure. Thank you for having me back.
Yes, we just had your developer boot camp, and that personally I think was right on par. What my favorite was your uranium boot camp, and I think this is a close second. Learned a lot from that. Doug's presentation alone on the tailings dam presentation, upstream, downstream, center line. After the boot camp was over, the first thing I did was go on Google Maps and start looking at these projects that I'm invested in to see what the repercussions could be if we have another Vale incident. We have your next boot camp coming up, the Prospect Generator Boot Camp. What can we expect from this boot camp, and tell us about it?
Steve, my suspicion is that this will be the best boot camp we've done yet. When I say best, what I mean by that is that prospect generators, in terms of early exploration speculation, are statistically the most efficient investment mechanism in the space, and yet they're very poorly known. And we have a great crop of exhibitors, and we have a great crop of speakers. I also need to say that I have been speculating in prospect generators now for 45 years. I have, if my memory serves me well, bought shares in about 70 of them over 45 years. And I've participated now in 23 exploration successes in 70 starts, which suggests a success ratio in excess of a third. If you look at that success ratio relative to the expected success ratio in exploration, you'll find that it's probably 2 standard deviations more successful. And as you know, I'm all about statistics. I also think we're coming into an exploration market, Steve. It's been really since the early part of the decade of the 90s that speculative attention and resources has shifted to exploration. So it's been a very, very, very long time. Way, way, way overdue. So I'm absolutely delighted that we're going to do this. Like with all of our boot camps, and in fact, all of our investment education products going back 30 years, this one comes with an absolute positive gold-plated money-back guarantee. If you aren't thrilled with the result, if you don't think you got your money's worth, email me, and I'll certainly give you your money back. Now, thus far, we had over 1,000 attendees at the developer boot camp, and we had 3 requests for refunds, which tells me that if the content that you put on is good, and if you limit admission to investors who really care, the refund feature is both from the attendees' point of view, but also from my point of view, an absolutely no-risk gesture. But it's out there. The financial risk is all mine. You'll note, too, Steve, that the keynote speeches that we always have, the hour or hour and a half long discussion that introduces the topic, has in every case, in the case of every boot camp that we have done, really been worth the entire price of admission to the boot camp. I thought the developer work that was done, the keynote speech by Doug was by itself worth the price of admission. Similarly, the keynote that Per Jander did with the uranium boot camp was absolutely positively, I think, worth the price of admission. I have 2 different keynote speakers that we're looking at for the Prospect and Developers Boot Camp. And I have to say, I'm thinking about doing 45 minutes each as opposed to one for an hour and a half, because I think that both people are irreplaceable. So I'm very, very, very excited about this.
As are we. We learned something from every single boot camp. So in 45 years, you've placed 70 of these bets. So that's like less than 2 a year. You're really nailing down getting the cream of the crop.
with the caveat that I'm 71 years of age this week, and my memory isn't as specific as it used to be. You will note that I said about 70.
Well, happy birthday. Happy
Thank
birthday.
you.
I'm going to share my screen here, and this is just some of your this is your uranium boot camp success right here. So the happy face is when the boot camp came on. The party face is where we are now. This is the Sprott Physical Uranium Trust. This is URNM. Here's Kazatomprom. Okay, each one of these, there's 11 that you presented in the uranium boot camp, which was almost 2 years ago. You know, I think the biggest lesson is time and being patient. You know, here's fission, deep yellow, next gen, our personal favorite, Uranium Energy Corporation. You'd be proud of us here. We're past the point of no concern.
Lovely.
Boss, CGN Mining. This one went up about 150% from the boot camp. And Uranium Royalty Corporation. And this is the only one out of 11 that isn't above where it was the moment you had the boot camp. But if you treated this stock like you treat tuna fish, we're very happy with it right now. So I can't say enough good things about your boot camp. They are amazing, incredible content, and you're really giving back to the community after having so much time in this sector. So thank you.
Three things I'd like to say about that. As you suggest, time is required to make money. Many speculators have trauma holding stock over a long weekend because they aren't well enough informed before they buy the stock as to why they bought the stock. That's what the trauma comes from, lack of knowledge. So what you say, it takes time. It doesn't seem to me like 2 years is too long to wait for a double from my viewpoint, but I'll leave that to your speculators. The second is the Uranium Bootcamp points out the intelligence of beginning to establish knowledge and positions when a commodity is out of favor. You buy the stuff when it's selling for 20, not when it's selling for 100. I think it's very important to do that. The third lesson is a bit more nuanced, Steve. I would urge all of your listeners who care about resource investing to view the boot camps in the context of the educational material offered up at the Rural Classroom. We have hundreds of hours of instructional material at the Rural Classroom, including 9 short courses out of what we hope will become a 60-part series that will teach you really how to understand the material presented at the boot camp, particularly the material that's presented by the exhibiting companies. So it's important to get your money's worth out of the boot camp that you spend some time at the Rural Classroom, which is absolutely free.
Yes, there will be a link in the pinned comment below if you want to join us for the next boot camp. I want to grow my finances just like you. So if you use the affiliate link, we will do that together. And the Rural Classroom in the show notes, there's a link down there as well. Can't say enough good things about that either. I mean, we had the Q4 come out for SilverCrest, and it looked good to me. But then I saw that you had a Q&A in a couple of days, and I thought, well, let's ask Rick. And so I did, and you saw the same thing, and I'm like, okay, it's a good peace of mind.
The financial results were great. Especially the non-tricky part, which is to say cash at beginning of period, cash at end of period, net debt at beginning of period, net debt at the end of period. Accountants can be fairly tricky with quarterly reports, but cash doesn't lie. That was helpful. I'm still needing more reassurance about the state of reserves and resources. I'm waiting for an upgrade reserve and resource state. I love, frankly, the operating results that they're achieving, and particularly, as I stated earlier, the fact that those operating results are generating real cash, which is used to improve the balance sheet. I want to have a better sense of reserves and resources so that I know that this good performance can continue.
Okay. Since we're on silver here, TLD, Rick has been very vocal about silver in recent time. Which silver company is currently most attractive for him? From an investment standpoint, not speculation. Is there such a thing as investing in a silver company, or is it all speculation?
I think there are, but the investment grade silver companies, most of them have me nervous. Peñoles, because of ongoing political concerns in Mexico. Buenaventura, because of spotty operating results. The one I feel best about is probably PanAmerican Silver, which has morphed into a company where 55% of the revenues come from gold. I'm feeling probably most attracted to PanAmerican Silver because it's disappointed so many people over the last 2 years that there's no momentum in the stock. And as you know, Steve, there's nothing I like more than hate. So I feel reasonably good about PanAmerican, both in terms of the operating results, but also in terms of the fact that I have no company on the bid.
Yeah, now, okay, so it's down in Guatemala. Okay, we just had Bluestone Resources got approved for open pit mining. So they were underground, which is
Yep.
highly capital intensive. I mean, you gotta bore this hole, then you gotta dynamite it out. As you extract the ore, now you gotta fill it up with leftover tailings and concrete so that the mountain doesn't fall in. Is there a chance, or I mean, is this good news for Pan American Silver and Escobal because they got an underground mine? Would that be beneficial if they could kind of get green lighted for the same thing, or?
I think the fact that the political establishment in Guatemala is still interacting with mining companies is a good thing. There, with regards to Escobal, has been substantial regional political opposition to the mine. What I suspect happened is what often happens in frontier market countries, which is to say that the social rents from the mine, the off-site subsidies, the taxes, the royalties, all went to Guatemala City. So while the center got the rents, the region got the shaft. The prior operators of the mine did a reasonably good job, in fact, a very good job, making sure that the communities that were immediately adjacent to the mine benefited, and they benefited mightily. What they did less well was making sure that the communities that were in the region, but not in the immediate vicinity of the mine, did well. And there was a lot of envy amongst people who live 15 miles from the mine site relative to people who lived 5 miles from the mine site. Part of what PanAmerican has been in the process of doing is reestablishing a social consensus to balance the need of the center, the region, and the immediate localities. This is a long-term project, and my hope is that it will bear fruit in 2024. My sources in Guatemala tell me that PanAmerican has done a reasonably good job fashioning a political consensus, but I note that there is still a large funded anti-mining NGO presence in Guatemala. So risks remain around that political consensus.
Okay. So they maybe appeased isn't the right word, but maybe it is. They appeased the locals around them, but a little bit further than that, they kind of dropped the ball.
Yeah, initially they did a really good job drilling water wells, establishing social programs, building schools, funding schools, buying from a wide variety of local merchants. So the areas within sort of 5 miles of the mine weren't happy. They were ecstatic. The problem became sort of 5 miles to 25 miles from the mine, where the lives of those people were unaffected, except that they saw the lives of people very close to the mine materially impacted for the better, and they became envious.
Okay, let's move on to uranium. So we
Great.
got quite a few questions here on uranium, most of them centering around Kazatomprom. And I just saw the other day in the news, apparently they fired their government. How do you feel about their decreased production forecasts, and what have you learned in this short time about the Kazakhstan government?
I'm actually fine about the near-term production decline. That occurs for a couple of reasons. Kazatomprom is apparently keeping the promise that they made to shareholders, which is to say that they won't restart the production that was temporarily halted until they have secured enough volume in term markets that they can sell the new material that they produce without disrupting uranium markets, and also for prices high enough that they earn a decent return on capital employed. Now, this perplexes people who haven't studied the uranium market because they see the spot at $100. Clearly a good price. Uranium that is going out on the term market right now is fetching about $70 with built-in escalations over the term. So what Kazatomprom wants is to secure enough contract in the term market that they can be sure that the material that they sell into that market will generate a reasonable return on capital employed. And we're talking about an amount of material, 12 to 15 million pounds a year, that is a rather substantial piece of global supply. The second thing is that restarting these projects is often difficult. In the case of their production method, which is in situ recovery, similar to a water flood in the oil and gas business, it isn't simply a case of turning on the spigot and flowing water back into sandstone. You have to have the water that comes into the ore body come in a very sustained and very consistent fashion so that the water doesn't break through or cone, causing what would otherwise be one ore body to become 3 or 4 different ore bodies. So the engineering challenge with regards to restarting a 5 or 6 million pound a year ISR is difficult. And the Kazatomprom guys are making sure, which is a very good thing, that they do it correctly. More concerning to me has been the turmoil in Kazatomprom with regards to their middle management, which I considered, separate and apart from their resources, to be the strongest part of the company. And I haven't been able to understand myself the internal politics in Kazatomprom that has caused so many highly promising middle managers to leave the company, pardon me. I don't know if it has to do with the interplay between the government of Kazakhstan and Kazatomprom. I just don't know. I could speculate, but my speculation is worthless because I don't know.
Yeah, I saw the same thing. It seems just like a rotating turnstile of these guys that have a lot of experience in this place and have started in the farm system from the ground up, and they're leaving. And do you still consider this a hold, or are you trimming your position on Kazatomprom?
I'm not trimming my position, but understand I'm different than many of your subscribers. In the first instance, I've been lucky, and I've been in the resource business for a very long time. I can afford a greater risk of loss. I'm also patient, and I'm really, really, really quality oriented. And these are the highest quality reserves on the planet. And I am willing myself to take risk because I have a look at what I think these resources are worth, at what I think will become a normalized uranium price. And the size of the prize is so incredible, even from today's prices, that I'm willing to tolerate some risk that I won't get there. Many of your subscribers can't either financially or psychologically stand that risk.
Okay. You mentioned something else, the term market. I remember we were talking probably about a year or so ago, and the spot market was less than the term market. So the spot market is a year or less time. The term market is longer than a year. And it looks like that is reversed. Now the spot market is, north of 100 and the term market is around 70.
Yeah.
Okay.
Yeah. I think there's a couple things that are important to note there. When we had the uranium bootcamp, the spot market was where most of the volume that was being transacted took place. That's changed. The term market is where the transactions are taking place now. The spot market has become fairly illiquid, including because Sprott took about 50 million pounds of supply, took it to supply heaven. And so the term market is underserved. The spot market, pardon me, is underserved. It's interesting to me that investors look for reference to the spot market. On many days, there is greater volume in the shares of the Sprott Physical Uranium Trust than there is in the spot market. So if you're looking at near-term pricing, my suspicion is that Sprott is more important than spot. The spot market is an easy statistic to get, so people are assigning it greater relevance than it deserves. we're going to have to work much harder over the next 3 years understanding pricing because the term market is very opaque. We, meaning people like me, are going to have to work backwards and look at things like volume sold and price received, because players like Cameco or Itochu or Kazatomprom aren't necessarily willing to give specific guidance on what their term contracts look like. So we're going to have to do a bit of sleuthing work. When 80% of the volume in uranium sales was taking place in the spot market had a lot of relevancy. Unfortunately, now it's only a frame of reference. It's a rule of thumb. Increasingly, the volumes are taking place in the term market. Now, this is important, Steve, and ultimately it's a good thing, because uranium is becoming the only industry in natural resources where a producer and a consumer both can have some sense of the price of material 8 years out, 10 years out, 12 years out, which means that the visibility on the revenue line for companies is much greater than the visibility on the revenue line in any other commodity where prices are set overnight in the spot market. And that visibility will assist analysts in doing earnings forecasts and assist investors in accepting the analysts' forecasts, because the data in the uranium business will be better than the data available in any other extractive industry. This is very important for your listeners and subscribers to get their head wrapped around.
Yeah, so basically you're saying that because they're doing these contracts years out, you can literally just, I don't know, do a spreadsheet and you can tell what their profit's going to be as they go out, correct?
And we will, as soon as we have some confidence in our spreadsheets, be willing to share those. It's really important. If you couple that, and I'm sorry to get so deep in the weeds, Steve, but I know that your listeners are passionate about uranium. It's important to understand that today, if you build a new nuclear power plant, let's say in China, which is efficient, you're building an $8 billion plant. They're borrowing $5.5 or $6 billion of that. And the lenders are requiring them to have enough material contracted in the term market to effectively amortize the loan. Which means that there is some certainty with regards to both the producer and the consumer about availability and price for a very long period of time, which is extremely useful for both sides. It's important to understand, too, that while utilities would like cheap material, the uranium supply to a plant is generally less than 5% of the operating cost of the plant. So that if the uranium price were to suffer a substantial increase, suffer from the point of view of the consumer, of course, it doesn't have a real material impact. The most important cost, frankly, is the amortization of the upfront capital cost to build the plant. After that, nothing else really, other than safety and compliance, matters.
Yeah, we asked Justin Hune about this a couple of weeks ago, and basically, he said the same thing, that the fuel cost of it is like 5%, and then we did a hypothetical. Okay, so if uranium goes to $200, now it's 10%. I mean, the math doesn't work out perfectly, but yeah, it's really such a small portion of how much the actual utility bill goes up that it's not like they're going to shut it down.
Compared as an example to either tax or interest rates, the price of fuel is literally a de minimis concern.
Yeah, yeah. Okay, there's some rumors going through the ethos that Cameco and Kazatomprom, having contracted out quite a ways with Kazatomprom's decreased production in the future, that they're actually buying some uranium off the spot market and selling it at a lesser price, which isn't a whole lot of fun. Have you heard the same thing?
I have heard the rumors. I suspect that both Kazatomprom and Cameco would be required to disclose that, were it true. You would also see it show up in their quarterlies. in the sense that the cost of material sold, cost of goods sold, uh, would probably be an extraordinary line item in the quarterlies. I have looked at that to the best of my ability, and it's true that they don't break it out, at least in a way that I could see, in terms of segregating goods sold by mine or spot market purchases. I suspect that if Cameco and Kazatomprom are having a shortfall in terms of their ability to deliver contracted fuel, that rather than buying the material for $100 a pound in the spot market, it is much more likely that they would attempt to fulfill those obligations from restarting material that's currently shut in, which both companies have suggested would be produced at a $25 or less per pound cash cost. Not a fully loaded cost. That $25 a pound is just a mine site number. It doesn't include depletion or depreciation. But if your cash cost was $25 as opposed to $100 in the spot market, my suspicion is that you would see those restarts occur sooner rather than later.
Okay, rather than paying more for something and selling
Correct.
it for less, they'll just start
Correct.
upping production. Okay, let's move on to oil and gas. Last time we asked about Woodside, you said you were doing some work on it. We got some questions about Santos and Woodside. Is there a possible merger taking place? Have you?
I don't think that the Australian antitrust regulators would allow that to take place. It would be wonderful if they did. You would have, in effect, a super intermediate. You would have a national champion in Australia, a company with wonderful technology, wonderful LNG holdings, and wonderful conventional holdings. If you look at the new Woodside, which incorporates BHP's global oil and gas business, you have a top quality global explorer. So while I would love to see that occur, and depending on the subsequent price, I would be a large buyer, that seems too good to be true.
Okay, what would you rank Woodside right now, or are you not completed on the work?
We tentatively have Woodside at a 4. The thing that kicked it up in my mind, this is subsequent to doing some work, has been President Biden's idiotic discussion about a hiatus on permitting of new liquefied natural gas capacity in the United States. That opens up a huge market for liquefied natural gas from the Northwest Shelf in Australia. President Biden, might call this the Australia, Qatar, and Mozambique Subsidy Act of 2024.
He'll probably name it the Inflation Reduction Act.
Yes, right. Right. Or the American Impoverishment Act.
Yes. All right. Paula wants to know Blackstone Minerals. Any updates on that? Still a 4?
I like Blackstone. I'm a Blackstone holder, unusually among oil and gas companies because of their mineral interests. It's a fairly easy company to analyze. You don't have to worry too much about operational efficiency because mostly they don't operate. Ironically, because their margins are so good, in a royalty, in effect, your gross is your net, right? Mm-hmm. What that means is that it's less leverage to increasing oil prices because their margins increase less because their margins are already so great. So if you're owning it because you believe in the thesis that declining sustaining capital investments mean that higher oil prices likely occur in the out years, this isn't ironically the right name for you. You own this one because it's a very high quality company, arguably selling for less than it's worth. I've told you before, Stephen, my declining years, you can take away some of my upside if you take away most of my downside. And my whole royalty and streaming portfolio occupies that sort of space in my mind. High quality companies, durable, sustainable cash flows, intelligent capital allocation, less upside to commodity prices, less downside to operations and commodity prices. A sleep night and stay calm stock.
Yeah.
I like that one a lot. The dividends are like north of 10%. It's pretty incredible. Um, okay, coal. Seasonality on coal. Have you noticed in your time investing in the sector that there seems to be, people like to stay warm in the winter. Nobody enjoys freezing. Have you noticed seasonality for met and thermal coal?
I haven't paid attention to it.
Okay.
Uh, Precisely because in met coal, demand for steel stays consistent and it fluctuates more around global economic conditions and in particular Chinese demand. And with regards to thermal coal, because what matters is when the Chinese and the Indians need to stay warm, or more particularly when they need to generate it for electrical power. What you're finding is that in terms of North American coal, there probably used to be some seasonality. In the thermal coal business, the United States is less important than it used to be, even including to U.S. producers. I was just in Washington, D.C. Over the weekend, and it's interesting to see the trainloads of coal coming from West Virginia and Kentucky into Baltimore Harbor to be shipped to Germany, that paragon of green energy. What's important to note is that the coal business has become so global, and that the thermal coal business has changed from being a US-centric business to being a much more global business. So US seasonality is of less importance. The other thing that I would say is, at least in terms of my own investment methodology, I've become increasingly interested in the 4 and 5 and 6 and 7 year term. So seasonality doesn't impact me as a trader so much as it did when I was younger, and ironically, I was less patient.
Okay, okay. Yeah, your time frames don't really care if it's going to go down
Right.
in the next couple of months. You're looking much more long term. Okay, gold. Jordan wants to know moose pasture mining.
Consolidated moose pasture is one I make fun of because it is, as I would say, representative of the length and breadth of juniors, which is to say it's a piece of junk. It is important to know, Steve, and your listeners always hate me for this. If you merged every junior mining company in the world to one company, Junior Explorco, that company would lose in a very good year $2 billion and in a bad year $6 billion, which is to say it is valueless. It is important, if you're going to take the risk inherent in junior mining, really truly searching for alpha, that you understand that all of the performance, real performance, is limited to perhaps 10% of the issuers. Amalgamated moose pasture and consolidated orangutan, both are euphemisms for the 90% of companies in the junior mining sector that deplete rather than add to your portfolio. They're to be studied in as cursory a fashion as you can so that you can reject them and never spend time trying to analyze them again, freeing your time and attention for high quality issuers run by high quality people.
Yeah, that's one of the main things that I got from the developers bootcamp was it wasn't necessarily trying to pick the best ones. It was taking 100 of them and getting rid of 92 of them fairly quickly, and then you're left with the 8 that now you can dive into.
Critical in every category. At the time we did the uranium bootcamp, as my memory serves me well, there were 72 juniors purporting to be in the uranium business. We narrowed that list down to 12 that I wanted to own that would be suitable as exhibitors to the boot camp. And this is in a sector where the ratio of viable companies to non-viable companies is high. If you take that down into the gold sector or the lithium sector, what you'll find is that the number of viable companies relative to the population of companies as a whole is probably more like 5% than 10.
Okay, Guyana. Reunion Gold and G2. It looks like it's possible that Reunion is going to buy G2. Which one do you think is a better value? Do you follow these?
It is easier for me to understand Reunion. It is arguable that G2 is cheaper, I believe it to be the same ore body. I believe that G2 is a different expression of the same mineralizing events. Thus far, G2 has not found the larger quantities of lower grade ore. They have found smaller qualities of very high grade underground material. I still believe it to be the same deposit, the same mineralizing event or mineralizing events. Given the relatively remote location of the deposit and the fact that, as I say, it's, I think, one deposit separated by a property line, it makes sense for the companies to merge, to build one big mine and not have duplicate overheads and all that kind of stuff. And I think that may occur. Right now, the management teams are competing for capital in the same capital markets, doing what you would expect them to do, slagging each other, saying, I'm better, stuff like that. They have a lot of common shareholders, myself included, who would like to see that end sooner rather than later, and see them become one. There is a different type of buyer that emerges for a very large mine. And although it's early days, and I could easily be wrong technically, I believe that the consolidation of the two companies could ultimately prove an ore body in the 10 million ounce size, roughly doubling the contained reserves and resources that have been identified so far. Really, anything north of 5 works. But a 10 million ounce deposit is extremely rare, particularly with its size, grade, and tenor. And I mean, I really think that if these companies merged and if they consolidated their exploration budget to optimize one mine, I think that this would be a deposit that any one of 5 companies had to own. And I look forward to the bidding war that might transpire in that circumstance.
Okay. Okay. So you see this as kind of like next gen and fission. These are two projects that are close enough that should be combined.
Yeah, next gen fission is an even more is an even better example. Now, Steve, I need to tell you, going back in history, 25, 30 years, the Canadian diamond mining industry had the same circumstance. Ekati and Diavik were 2 diamond discoveries, parenthetically north of where Santa Claus is alleged to live, like way, way, way up there. As my memory serves me, they were 19 kilometers apart. And inexplicably, they built 2 different mines. They duplicated all of the infrastructure. It probably cost the combined shareholder base $500 million to sustain that idiocy. So the mining industry is capable of doing some phenomenally stupid things. One would hope that that lesson is fresh enough in investors' minds that the management teams at NextGen and Fission and the management teams at Reunion and G2 aren't allowed to do that.
Okay. All right. Our most popular question, actually, the one that got the most thumbs up, from David W. Please ask about the future prospects for Metalla royalties.
I think the merger of Metalla and I forget its sister company into one company,
Nova.
presents a much more compelling opportunity than existed when they were separate. You don't have to worry anymore about conflicted time and attention among management. On Monday, you used to have to ask yourself, well, who are EB and Brent working for today? Are they working for me or somebody else? Both talented guys. You don't have to worry about that anymore. 2, they have the size and scale to increase trading liquidity, which lowers their cost of capital in a capital-intensive business. I need to say that I don't own the combined company yet. It is not on the list of royalty and streaming companies that I own, but I also need to say that I'm looking at increasing my exposure to the sector. And it's certainly one that I'm looking at carefully with a view to doing that. I think it's much more attractive together than it was apart.
Okay. What number would you give it now? Like
I haven't assigned it a number.
Okay. A whole bunch of people, boy, Tisha, Manuel, newfound gold. Eric Sprott, I guess, owns a fifth of the company. What have any insider view when they might be going into production? What's your thoughts on newfound?
It's been an amazing series of discoveries. Thus far, there isn't a mine there. Thus far, there are a series of either lenticular veins or pods. And it's difficult for me right now to draw a plan view or a mine view cross-section that makes one big mine. It looks to me like they're going to have to build a central processing facility, and they're going to have to have to draw from a lot of small separate operations. I hope I'm wrong. I'm incredibly pleased with the success that they've enjoyed, but I think one of the reasons why you haven't seen an updated resource is the lenticular or poddy nature of the deposit. The market has rewarded them extraordinarily well for the high quality hits that they've enjoyed. In recognition, I think, of Eric's superb track record at analyzing these sort of things early and not confusing himself too much with the nature of the deposit. And also, frankly, with the unbelievably good communication skills exhibited by Colin Cattell, the CEO. I don't own it. For me personally, the market capitalization relative to the reserve and resources that I can put my thumb on, and the production rates, I just don't understand the deposit well enough to be able to pay the price that the market is charging for it. Now, it's important to note that several times in my career, I have been unable to see what Eric Sprott has been able to see. And the consequence of that is that I used to work at a place called Sprott. He never worked at a place called Rule. So.
Okay. All right. Pockets are just a little bit too spotty for you to really wrap your head around. So
Right.
You don't completely understand it, then we don't bet on it. All right. Moving on to nickel. Ivania, User, Jeffrey, and a whole bunch of other people. Centaurus Metals out of Brazil. They get mostly nickel, but I think they have also got a little iron ore, copper, and gold. What? How do you feel about Centaurus?
I have Centaurus at a 4. If I thought that the nickel market was closer to turning, I'd have them at a 3. This is a potential world-class deposit, both in terms of nickel, but also in terms of platinum and palladium. I expect all of nickel, platinum, and palladium to likely trend lower in 2024. I expect that because I think 2024 is a replay of 1990 and 1991, where the Russians needed money. And when the Russians need money, they sell whatever they have in the cupboard. And what they have in the cupboard is copper, nickel, platinum, and palladium. And until you've seen the end of Russian dishoarding, you will see downward pressure in those markets. The nickel market is further constrained by the increase in laterite nickel production in Indonesia, which I expect happens for another year and a half. Recently, I flew over the nickel mines in southern Sulawesi in Indonesia, and I must say that even a hardened mining observer like me will be horrified by the environmental devastation that's occurring in Sulawesi, the offshore tailings disposal. And I don't think that the Indonesian citizenry or the Indonesian government will continue to permit an increase in the size of the devastation that's occurring in Sulawesi. Having said that, if you are looking at nickel markets or platinum and palladium markets, the idea that you're going to experience much joy in 2024 is low. I love world scale deposits. And because I have a 5-year horizon, the fact that Centaurus will be challenged, the fact that Bravo will be challenged, the fact that these high-grade mafic and ultramafic Brazilian deposits, which I believe will become world-scale deposits, are facing soft markets, is attractive to me. I realize that you have some listeners who have either the psychological or the financial need for quicker gratification, and those people would be well advised to avoid those stocks.
Okay. And is there any concern looking, I don't own Centaurus, but I was looking at it and it looks like they're diluting shares quite a bit. Is that, they're just
Yeah,
raising
they're
capital?
at the stage where they have to do that. What you need to do with that deposit is really two things. You need to quantify the size. And I think this easily has the ability to be what I would classify as a tier one deposit, meaning in excess of $10 billion dollars of recoverable in situ reserves and resources at today's commodity prices. But you need to prove that. You need to give that to the market. You also, in a deposit that size, need to develop out a high-grade core so that you can recover in the early years the upfront capital costs involved in building a very big mine. And while you're doing that, you need to extract enough rock that's representative of the different ore types that you can do the metallurgical work that's necessary to build a processing plant that's optimal. All of that requires money, lots and lots and lots of money. That's why the pre-development phase and the development phase is often regarded as the boring part of the mining business. Lots of money goes in, and at the beginning, not much certainty comes out.
Okay. Let's wrap up here with PGMs. So platinum and palladium have absolutely been hammered, and you could see some more downside because Russia may need some capital. They're sitting on a pile of platinum, palladium, and nickel. You could see them throwing that out into the market, which would flood it with supply. But eventually, they're going to need that again. What's your forecast for the PGMs?
Well, what happened in 91 is the Russians simply ran out of platinum to sell. Like a merchant that has a fire sale. When everything's gone, the fire sale's over, right? And that's what happened to the Russians the last time through. I think it's what's going to happen this time, too. The Russians need money. Now, it's true that they sell oil and gas to India, which resells oil and gas as Indian oil and gas, refined oil and gas. So the Russians are able to sell oil and gas, but they need to sell everything they can to sustain their domestic economy while spending billions on a war. So you can rest assured that until they have sold all of the platinum and palladium that they can sell, that there will be no hiatus. What will happen is that while they're selling the material, they will be causing the big producer, Norilsk, to pay high dividends, which constrains their sustaining capital investment, which impairs Norilsk's ability to participate in the platinum and palladium markets when the price goes up. Will that blessed event take place in 2024? I don't know. Likely not. The fly in the ointment would, of course, be a settlement to hostilities in the Ukraine, which would reduce the Russians' necessity to conduct this fire sale. It's important for people when they're looking at platinum and palladium to understand that part of the speculative appeal of platinum and palladium is precisely because it's produced in a very few risky places. The sources of supply that matter are South Africa, deteriorating from my point of view, Zimbabwe, improving a little bit from an extraordinarily low level, and Russia, which is a wild card. If you experienced severe social disruption in South Africa, Zimbabwe, or Russia, what you would see is an immediate and catastrophic decline in supply in platinum and palladium. The narrative around platinum and palladium is soft because people believe fallaciously, from my point of view, that we are at the end of the era of internal combustion engines. The principal uses for platinum and palladium are as an auto-catalyst to reduce smog emissions from internal combustion engines. My suspicion is that the demand for internal combustion engines will stay strong for at least 25 years, and that global demands for clean air will mean that platinum and palladium utilization in auto-catalysts will continue for another 25 years. So my suspicion is that the narrative around constrained demand for platinum and palladium is fallacious.
Okay, I'm gonna share my screen here, and this is a chart that I made up. This is basically adding platinum and palladium together, dividing by 2 to get the average cost per ounce of both of them combined, and its relation to gold. So you can see that it is just in the toilet over here. You know, half one coin of or 1 ounce of either one of them would only buy you half an ounce of gold. But look at this moment in history back here in 2001, and it got all the way up to 3. I mean, historically, really cheap. This goes back to the 80s. But you could see this persisting just a little bit more before Russia runs out of product, and then we're off to the races.
And if you had severe social disruption, particularly in South Africa or Russia, you would see that spike repeated on steroids.
Wow.
Remember that at today's prices, it takes about $125 worth of PGMs to make an auto catalyst that sells a $40 or $50 or $60,000 car. What that means is that if the price of platinum or palladium doubled, it wouldn't change the price of the product that enabled its sale. If the price of catalytic converters, if the price of platinum in a catalytic converter went from $125 to $250, it wouldn't change the sales of the $50,000 car that catalytic converter enabled the sale of.
Yeah. They're not going to stop making the car because the catalytic converter costs $250 now instead of, or the platinum and palladium in the catalytic converter costs double. Okay.
All right. Well, awesome. Thank you very much, Rick. Do you have any final closing thoughts?
I do. Anybody who's enjoyed this conversation is invited to continue it. Go to ruleinvestmentmedia.com, list your natural resource stocks. I'll personally rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. I encourage you all to go to the Rule Classroom, where there's a couple hundred hours of instructional programming on natural resource investing, all free. And of course, I invite any of your listeners to join the hundreds of your listeners who have attended our boot camps in the past. These are 8 hours. You can view the tapes for a year because you won't get all of the information. You won't absorb all the information in 8 hours that you will need to master the topic. Comes with an absolute positive gold-plated money-back guarantee. If you didn't get your money's worth, I'll give you your money back. Finally, if I can give you one more commercial, we have a banking organization, Battle Bank. If for some reason you are unhappy with your current bank, I suspect that extends to all your listeners, at ruleinvestmentmedia.com, write bank, or visit battlebank.com online for more information.
Thank you very much for reviewing the companies. If your company wasn't brought up, ask Rick yourself. The Q&A at the classroom, or by having him review your portfolio. Links are down in the show notes. We hope to see you at the boot camp. There's a link in the pinned comment below. Thank you in advance for using that link. And thank you for tuning in. Hit the like and subscribe, and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.